text hub is directly above the voice hub. So if you want to jam a question there, I'll keep my eye on that and interrupt Kevin on your behalf if you are shy to do it. And with that, I think we're ready to kick off, Kevin.
Okay, and everybody can see this? This is a check. The screen?
I think so, yeah. If you're not seeing it, you're going to want to click on the Voice Hub channel name at the top, and then you can click on the you click on Kevin's stream. But yeah, I think you've got
Cool. Will I start?
Yeah, it looks like you've got 28 viewers on your screen right now.
That's great.
Cool. Yep, go ahead and kick off.
So I assume most people have probably read a little bit about the range tokens and success tokens. So I think we'll do a review of it, but I want to do the review more in a way of how we came up with the idea and how we kind of pieced it together. And I think that might help in the understanding of it, and also help a little bit in terms of understanding the potential needs of a DAO and potential ways of fundraising. So the idea of range tokens and success tokens really came about when we were thinking about different ways for DAOs to raise funds and diversify their treasury. The only method that was really out there was basically DAOs selling to investors at a fairly steep discount and for their partnership and for the lockup. So we wanted some alternatives, and we wanted to explore different methods. We also wanted the other big thing that we wanted to do was also kind of align the incentives of investors more with the protocol, and try and think of creative ways of doing that. For example, with our KPI options, that's one of the big things we want to focus on, was basically just aligning those incentives. And then the other last thing that we wanted to really tap on was that most treasuries in the DeFi space are primarily in the native token. So a lot of people needed that diversification. But the other thing that we wanted to think about more was about how can we unlock that concentration of tokens and use those tokens in a way where it to be an advantage for the DAO, and to kind of create these kind of specialized products that can perform different things. So first with the range token. The range token really is just convertible debt. And that's kind of what we call it in the venture capital world of traditional finance. So in that startup world, a lot of times people are raising money without actually knowing what the actual price of the equity that they're buying. So effectively, somebody may say, like, you could buy a portion of my company. You're going to invest $100,000, but we'll determine what that price will be in the future when I actually do an actual financing round where I raise money or where I actually sell some of my equity out. And at that point in time, we'll determine the price. So the range token is very much similar in that way, where we're getting the funds upfront from the investor. We're actually not determining what price we're selling those tokens at yet, and that price will be determined in the future. So the range token really is essentially is the main part of it is effectively that is basically determining that price to where we actually strike that price in the future, where the DAO will actually sell those tokens to the investor, but the money is actually given upfront from day one. And I think it's very useful for especially a lot of early projects to consider this, because they haven't really accrued much value in their protocol yet, because they just started building it. They are expecting a lot of growth coming in, so they want to strike that price in the future, effectively, where they've kind of picked up some momentum. And it also works in the case, say, like right now, where the markets are a little bit depressed. In the case of Sushi Swap, many people think that they're probably undervalued. That's really where this idea came from, where we were trying to find a mechanism where people could actually determine that price of where they sell their tokens in the future instead. So this is basically the Sushi Swap proposal that we had initially brought up. And I'm not going to go through everything right now. We'll kind of look at some of these piece by piece. But in this case, the range token really comes about by effectively defining how many tokens are awarded to the investor at settlement. So for example, when we have an investor that invested $100, they don't get any tokens up front, but they'll get the number of tokens in the future. So if say Sushi Swap settled in 2 years time or a year's time at say $10, then that $100 converts into 10 sushi tokens. So basically 100 divided by 10. But then with the range token, we actually define a bound as to how many tokens that range is possible. So the most number of tokens that that investor can get is 25 tokens, which would basically equate to sushi price going down to $4. Basically 100 divided by 4 would be 25 tokens. And the most that the investor could ever get would be 6.25 tokens, which effectively would be 100 divided by 16. So effectively that's why this token is called a range token, because it's bounded by how many tokens the investor can get at the end. And then, of course, it creates these kind of interesting risk profiles on this bottom right here, where the tokens are bounded between 25 and 6.25. And when you convert that into actual value, basically taking the number of tokens times that price at that point, you kind of create this range-like payout, where the investor is basically exposed to the downside once they're below $4. They basically convert their full amount, full equivalent $100 into tokens at this range from 4 to 16, and then 16 onwards, they always get 6.25 tokens. So effectively, they get the upside of sushi from then onwards. That's a quick overview of the range token, but I'll break it down as to how this idea came about, and you can see the components of this range token. So range token really started off by thinking about how do we use a DAO's concentrated amount of tokens, use that to borrow. And I think a lot of people familiar with UMA would understand what a yield dollar is. Effectively, a yield dollar is basically using a collateral to borrow money up front. And in this case, we think about a DAO using their tokens as collateral and borrowing money. Most of the time, in the yield dollar example, you would need 125% your you need 125% collateralization ratio. So for example, if you wanted to borrow $100, you needed to have $125 worth of tokens collateral to ensure that the lender gets paid at the end. But if the token price starts to drop though, and then the DAO or the lender needs to continue to put more and more tokens back that collateral. If not, then they would get liquidated. As you can see here, this is more of an illustration. As the price of the token drops, like say in the case of sushi, more and more tokens are needed to basically back that loan, to ensure that they do not get liquidated. And also at final settlement, say if sushi was at $1, right, and sushi went from say $10 to $1, $10, you would think that you're converting 10 sushi to pay off your $100 debt. If your token price goes down to $1, then now you need 100 sushi tokens to pay off your debt. So it becomes quite scary or concerning for a DAO to really borrow funds in this way, given how volatile or how wide of a distribution their token price can go to. So there's a risk of liquidation is one disadvantage, and the second disadvantage is just a huge, extreme dilution of existing token holders. Because existing token holders would not want to basically see a massive amount of tokens given up at settlement in order to pay back this debt. And then we thought about, how do we protect the DAO in these scenarios? And we decided to put put option into there. And effectively what the put option really is we're just capping the amount of tokens that we will finally give to the investor at the end. In this case, with sushi, I can scroll back here. We said the most we would ever give is 25 tokens to investors. That basically ends up being the same as a $4 price. Instead of saying if the sushi price went to $1, we give up 100 tokens to the investor. the protocol now says, okay, the most we'll ever give is 25 tokens. From then onwards, under $4, you will still only get 25 tokens, and you will effectively have exposure to our token price. Then the payout starts to look like this. At every price above $4, the investor always gets back $100 worth of sushi tokens. And the number of tokens is always capped at 25. And as price rises, the number of tokens needed to pay back that debt starts to decline. And as the sushi price starts to rally, then it starts approaching zero as the number of tokens that needs to be given to the investor. I think that seems quite advantageous to the protocol or the DAO. But then, because of this option that the DAO wants, it becomes quite expensive. If you actually try and price out this option, most investors who have some experience with options would say, well, that's quite costly, and in order for me to do this type of financing, I would require a very high interest rate to do this. And we thought about, what can we do to offset that? And as you can see from here, as the token price starts to rally, the protocol, in this case like Sushi, is giving up less and less tokens to the investor. So then we could find an area where the protocol is actually comfortable saying, like, no matter what happens, no matter how far this market rallies, we'll guarantee that we'll give you a certain number of tokens. In effect, that becomes effectively giving the investor a call option. It's kind of like what we have here now on the next slide. Basically, it's a yield dollar as a put option plus call option, and that's what the investor gets. So now we've effectively defined a range where we say that the most number of tokens you'll get is going to be 25 right here in this red line. The fewest number of tokens you'll get is going to be 6.25 right here. Then you can see in the chart that's how that number of tokens changes over time. Effectively, then you create a structure where the investor has exposure to the underlying token, Sushi in this case, under $4 and above $16. And that effectively creates this range token type of structure. I think to us, hang on a second. To us, I think it's a fair trade-off. Trading off that put option, that call option, it makes a lot of sense for the DAO. The DAO is protected from this liquidation type scenario and this huge dilution, and in return they're giving away a call option to the investor to pay for that put option by giving that investor upside after a certain point in time. The reality of it is that in order for an investor to actually do this, it would actually also reward the investor some kind of a yield waiting till expiry. Because effectively, the investor is giving US dollars up front, not getting any tokens, and waiting till expiry to get their tokens. And also, and also just waiting for these options to kind of expire. So what we actually do here is we actually try and embed some kind of a price or discount into this token that it gives some kind of a return to the investor. So that even though this right here says 100, this blue line, as a final kind of settlement to the investor, in reality, they're actually buying it below 100. So then, in return, they'll get some kind of a yield in this range. How we price that, I don't want to get too deep into pricing of it. As we said earlier, it's effectively the investor is giving up put options, and in this case, as we can see right here, they're giving up 25 put options. They're getting 6.25 call options for 100 USDC worth of this structure. So you could basically put this all into a Black-Scholes model, make some assumptions, which that's probably the hardest part, is trying to figure out what the implied volatility of these options are, then try and price out what this package of options is worth. And you will have the value of this package of options. And then we could also provide some kind of additional discount to it, then it creates this yield. So even though the yield is 25%, the effective yield really is only around 8% because the option is the large portion of this discount here, which we see is like $8.92 per $100.
And Kevin, in that scenario, the yield was 25% because this is dated like 6 months out, right?
Yeah, exactly. That's right. So this was an initial proposal. So I think the proposals there's like different proposals coming in. Now it's more of a success token. It's a 2-year expiry. They're still trying to figure out the strike price for it. But yeah, so this is just taking the initial proposal that we had for the range token.
Kevin, also, sorry to interrupt again, but you'll probably cover Smog Bonds later on, but the first structure you showed with the yield dollar minus the put option is essentially the other thing that was proposed in the sushi forum, the Smog Bond, right?
Right. So the Smog Bond is effectively the yield dollar minus the put option. I don't know the exact terms that were proposed for it. It's effectively the same idea where the protocol is effectively borrowing, using their tokens as collateral, but they cap the number of tokens that they will pay the investor at the end. Again, it creates this kind of structure where the investor actually has downside exposure or exposure to the token below a certain price. There's no upside exposure for the investor. I think the biggest obstacle for the Smog Bond is really figuring out where to price this thing, because in our scenario, like say, just in a very rough way, if we go back to this this pricing chart here, this option, these put options that we're making the investor sell is actually quite valuable. And if we didn't have these call options offsetting it, then there's going to be a massive kind of discount that the sushi protocol needs to pay. And effectively, the sushi protocol isn't necessarily like just giving up something for free, but they are paying effectively a huge premium for those put options. And to us, like we don't it's not clear that that's what they want to do. And in some ways, you would rather want to offset those options by giving up another option that the protocol is happy to do. So to us, I think the range token is a lot of it is just a trade-off between risk that the protocol wants and risk that the protocol is willing to give up. And in return, hopefully, we find investors that basically want that similar type of risk or the offsetting type of risk, and then you take it at a fair price. So the other proposal that's discussed is the success token. And the success token is actually quite simple. It's effectively an investor being rewarded or being given a token plus a call option on that same token. And the reason why that the investor is given this call option is that there's always this discussion that because of these VCs are holding this investment for 2 years and they're restricted from selling it, and they're also giving some partnership benefits, that they should be given a discount. So all that we're really doing here is that we're converting that discount into a call option. So instead of the investor getting that discount, they're taking that discount and using it to buy a call option from the protocol. And to us, we think that it's a better structure, because if you're giving a discount to the investor, you're effectively saying, okay, I'll pay for your partnership and your agreement to lock up these tokens upfront. I'm paying you this discount right now and giving it to you upfront. Whereas in the success token format, we're basically saying, we'll give you this benefit of a discount or in return for your lockup in partnership. But instead, you're going to have to earn it. Like the only way that you'll get paid is if this option gets in the money, and if our protocol if our token starts to rally, and then you will basically benefit from the success of it. So it's almost like just switching around the structure or the payoff and or incentives of how this partnership's being arranged. And so here you could see that each of these success tokens really just needs 2 tokens to collateralize it. So if Sushi were to create these success tokens, each one would just be backed by 2 Sushi tokens. One token would effectively be the token that the investor buys, and the other token would be the collateral for that call option. As you can see, with that $15 strike, as the price of Sushi starts to rally, then you could see more and more tokens are released to the investor. And then from the payout, you could see that the investors exposed to Sushi 1-to-1, and at $14, their exposure starts to increase, and that you can see the steepness of that curve right there. Yeah, so the success token is not very complicated. It's just basically 2 parts being put together, two simple instruments. So in a very big picture way, in a very general way, like the difference between the what a DAO should think about between a range token and success token is that the range token basically allows the DAO to borrow funds upfront, and they'll determine the sale price of their tokens in the future. So it works well if if your project, you believe your project is undervalued, or you believe your project is relatively young and expected to grow in the future. Whereas a success token is effectively selling at today's prices, but with no discount, instead rewarding the upside to the investor if they're successful in taking that protocol to a higher price. So in some ways, it actually better aligns incentives with the investor in a little bit more than, say, the range token. Whereas the range tokens has that incentive alignment, but it's not as it's probably not as sorry, the investor doesn't get as much benefit as what you would get in the success token. And what I did in the last chart is I tried to do comparison between the two. So this one might look a little more complicated, and we can discuss it more. But so what I did is I took our original proposal of the range token. The expiry of it was actually only 6 months, as Sean had pointed out. Right? So I extend that expiry to 2 years to match the current success token expiry. Then I also add on. I did a little bit of thinking around to try and match things up. So we had used an initial $8.50 price on Sushi. So basically, I created a different call that's a $17 strike because they wanted a 2-to-1 or a 2 times out of the money call. And then I plotted the two together just to try and compare them. And what I did is I gave the range token a 20% APY. As you can see here, the range token scenario, this is the number of tokens that's rewarded the investor. The range token scenario, there's more tokens given to the investor as the price of Sushi goes down. There's less tokens given as the market rallies. And this is how that payout structure looks like. Whereas in the success token, it's the same number of tokens below that $17 strike price right here, but then that starts to increase this time as price starts to rally. And then we can put it into here where we look at the actual value in US dollar terms. You can see from the range token, sorry, let's do the success token. In the success token, you can see that it's just a 1-for-1 of exposure to Sushi. At $17, then they get more exposure to Sushi. Whereas in the range token, the investor is actually protected up to a certain point, Sushi, and then it starts to decline. The value starts to decline if it goes to 0. But then the flip side is their payout is less on a rally. It kind of gives you a comparison, also gives you an idea of what the protocol is giving up in terms of tokens in each of these scenarios.
Kevin, I just wanted to clarify the chart on the left is how many tokens are being paid out, and the chart on the right is the dollars.
Yeah, exactly. The chart on the left is number of tokens being paid out, and the chart on the right is like the US dollar value worth to
Gotcha.
the investor.
Sure. So the basically like the success, this is just showing us that the success token will pay off better in the event of a rally. This is what you just said, I realize.
Yep.
But there's like less downside protection than there is with the range token.
That's correct. That's
Okay.
right.
Cool. Yeah, that's a really useful chart.
I'm almost right at the half-hour mark, so I'll stop it here, and then we could just kind of open the discussion for everybody. Were there any questions?
Yeah, thanks, Kevin, for that. Well, I definitely have a question, but let me open it up to anyone else. I'm going to unmute some people I need. Yeah, so like first off, like let's hear from some superhumans. You know, we've been kind of pitching this idea to different DAOs. Kind of curious if any questions are lingering from like Shapeshift, for example, that we want to clear up.
Wouldn't say that I have a question specifically about a project, but just to make sure that I understood it right, the range tokens are more better utilized for like a startup or a younger DAO, whereas the success tokens are more geared towards more established and ready to go businesses. Did I catch that correctly?
I think that's partly true. But also, the range token can also be used if you believe that your project's undervalued and that you don't want to sell tokens at the current price, and you rather sell it at a future price instead. Like, say you believe that prices are depressed right now, and you believe that DeFi market will rally, and that your protocol will grow. Then you would want to use a range token. I think the flip side to all this is that it really depends on also the negotiation with the investor, right? Is the investor going to be okay with that structure, and maybe what's the price for that structure that makes the investor willing to take on that exposure relative to the success token. So there's always trade-offs, but like I think it can be used in both cases. But your generalization of it is kind of correct.
Sweet. Yeah. Cool.
Thanks, Coach. In a little while, I wanted to ask if you had any questions to ask from the Shapeshift campaign.
I did, but I guess I didn't. I tried to jump in, but I don't think I was pushing the button that I needed to push. You guys hear me now? I think from what I'm kind of getting a feel of over on Shapeshift from some of the questions that are coming up are about like kind of how could this benefit them with the lack of immediate VC investors? Say like the DeFi community was the only interested party at the time of minting these. How would they go about creating a market for it and distributing those?
Yeah, I think some of that's not very apparent right now. The UMA range token was the first token built, and that was just a couple weeks ago. And so it's not clear as to how the markets will get started up in terms of the secondary markets. There's definitely a little bit of complexity to it with the options in there. But I would think over time that it would just be a natural thing where a secondary market will be created and people will start trading them. I think most of the initial use cases have been more of like formalizing a deal with VCs as you're kind of pointing to, and in some ways it's more like putting on chain a contract whereas in the past it would have been put into legal documents as to how this would be done and done in a back room. And whereas now everything is kind of out in the open, and everyone's discussing these different parameters and how it should be structured, and then putting everything on chain in a decentralized way. I think that's really the first step. But yeah, I think the next step would be understanding how everything would trade in the secondary market, I guess. And it's not fully determined yet.
So somebody, oh, I'm sorry, go ahead.
No, I was just thinking that was a great explanation.
And Kevin, Apollo is saying he's unable to talk for some reason. I guess the push to talk setting might be on, so you might need to hold a button down in order to talk. But he asked in the chat, are these tokens only available for VCs? Can success tokens and range tokens be sold to community members? And I think you kind of addressed that already, but is there anything else to add on that, Kevin?
I think it depends. Really depends on the project, in how they want to approach it, and whether or not they're comfortable with it. I think definitely some community members have shown interest in these tokens, but it's really going to be I think it's very individualized, I guess, to what the protocol wants to do and what they feel comfortable with. So I don't think there's a right or wrong answer yet. And then again, it's still very early on, so nothing there hasn't been any precedents set yet.
But it really hasn't.
Yeah, that makes sense. Does anyone want to chime in?
Since we're talking about like creating secondary markets for these, Kevin, do you think something like active Uniswap V3, maybe not perfect, but like a feasible route?
Yeah. I mean, I definitely think so. I think it's going to be. I think you could still put it out on like a V2 AMM, but I think a V3 probably makes more sense. And if people want to have it in a passive strategy, somebody could create a vault and effectively provide market making that way. But I could also see it more used as like a limit order book, where people may just put a range orders up and say like, this is where I think I want to sell these things, and this is where I want to buy them, and then people start matching up orders in that way. I could definitely see, for example, like there may be some, with some of the discussions we've had, like there are some protocols that believe that they could actually pay back that debt and not actually convert their range tokens into tokens. They may say like, we've earned fees and our debt looks cheap now, we might buy it back. So in that case, you can imagine them leaving also range orders in there to actually buy back their debt, and eventually people matching off in that way, or vice versa. You could see people either doing auctions or actually putting it out on V3 again. You can see a protocol just putting in a big range order in there at maybe a slight discount and saying, we'll sell this to the community at this price. If you want to buy it, come in and lift that offer and take those bonds from us, or take those tokens from us.
Very cool. On the buying back debt topic, do you think that works better with like range tokens as opposed to success tokens, since like theoretically within the range the price is like more stable and you can kind of, I don't know, yeah, you can buy it back rather than just like buying your token back?
I guess it could work with both. I just feel like range token is more like debt, so that you can buy back. But I guess if the protocol has enough resources or has generated enough fees, I mean, they could buy back either one, if they believe that their structure is discounted. And I guess that anybody could do that as well. But yeah, I think it could be either structure. But I just thought about it more because of the range token, because it's more like debt. It's kind of like you're paying back your debt in some ways.
Cool. Thank you.
Kevin Kriptowski asks, can you discuss why the number of success tokens increases with price? I feel like that is less dilution friendly, especially since the number of success tokens already granted at a lower price.
The number of range tokens increases in price.
The number of success tokens increases with price is what the question says.
Oh, and that's all that's happening is that because of the call option, the investors just given more tokens as the price increases. It's effectively basically it's just a payout of the call option. So maybe what needs to be explained is that these call options are cash settled with the native token, right? So like if you think about like so some people might think about like buying options on a stock. In those options, you say you can buy Microsoft at $100. Then you at expiry you basically have to go in and give your $100 to the exchange, and in return you get the Microsoft shares. And say if Microsoft was at 150, you give your $100, you get the $100 worth of shares, or your $100 your share, and then you basically make that profit from 150 to 100 by getting those shares and then selling it back into the market. But in this case, we're doing it in a cash settled way where the economics are basically just paid to the investor in the number of tokens, right? So it's effectively saying like if sushi went from price of 15 to 30, you make $15, but you're going to get paid in sushi instead, right? So then you would get so at 30 if sushi's at $30, in order to make your 15, they'll give you half a sushi for that. So but then as the price of sushi starts to increase, then you need to give more and more of that sushi, more and more sushi tokens to kind of pay for that increase in price. So really that's all that's happening. It's not like anyone's being rewarded more call options or anything like that. It's basically just the way that the mechanism is used to settle this call option.
And so, Kevin, like as the price of sushi approaches infinity, you would just be approaching a maximum of 2 sushi payout for a single success token. Is that right?
Exactly. Yeah, one for the token that's being bought, and then one for the call option. So effectively, the call option payout is basically from 0 to 1 token, right? And the formula is basically the price of the token minus the strike price over the price of the token. Right. So then it basically approaches 1 as it goes to infinity.
Yep. So we have a question from the Real Tuna. In the case of Pool Together, we have a well-diversified treasury, but definitely believe our token is undervalued. Does using funds generated from issued range tokens to do a token buyback seem like a good use of the range token?
So basically, that's interesting. I would need to think about it more, but that sounds like it makes sense. It's kind of like basically borrowing money and doing a share buyback. Yeah, I think in many ways that probably makes sense. Yeah, I would need to think about more of like the intricacies of it, but in theory, I think that totally makes sense.
You have
anyone else in the UMA team has anything to add to that? But yeah, I think that makes sense. It's actually pretty creative. It's actually kind of creative. It's kind of using some of the traditional finance type of thinking, kind of perform to do something.
Is that a model we see in TradFi where organization would borrow money against its equity and then use that money to buy back its token or stock?
Yeah, I think that's definitely been done. Where in traditional finance, a lot of the kind of capital markets kind of thinking or decision making is about what your capital structure should be. Like how much equity should you have, how much debt should you have, or should you be using to finance your operations. There are definitely times where people would say that, okay, well, debt's really cheap. It costs very little to borrow right now, so I could go out and borrow funds and buy back my shares. And then some people argue that adds value to their corporation and into the market value. But yeah, it's all debatable. But like that's like the idea of it. So in this case with Pool Together, I think there could be something that could be explored. But I guess one thing that you have to consider is what that price would be. How much of a discount or how much of a yield would you need to pay in order to borrow those funds with a range token, in order to support that kind of token buyback operation.
Evan, my question for you is kind of a question that I get over and over as we talk to teams about this, like DAOs that are interested in doing it. Like, they understand the mechanism, they understand that they don't want to just dump their token or create sell pressure immediately, etc. But they basically don't really feel confident to pick the price, to pick the expiry time, to pick the the range of strikes. I'm kind of curious what advice you can offer on that, and like what we should be telling DAOs to do to kind of start down that process. Yeah, just curious, any thoughts you have on that in general?
Right. I mean, yeah, it's a very wide open kind of discussion. I don't think there's a right or wrong answer in a lot of these things. I think for us, like the maturity or expiry of it is something that is probably easiest to define. That how long do you want these tokens to be restricted for? How long are you kind of formalizing this partnership agreement with your investors? So some people like having a very long time frame. I think in the sushi case, it's a lot of people are talking about 2 years, good time frame. The choice of the prices or of that range is much more open ended. It's almost like what are you comfortable in terms of dilution? Like how if you're going to be kind of borrowing funds in this way, how many tokens are you willing to give up in the case that the market comes down and you need to basically use your tokens to repay that debt, right? So some people might feel comfortable offering like 100 tokens worth. Like, sorry, if the token price went to $1, they feel comfortable kind of repaying that debt with a lot of tokens. Or some people say, we're concerned about diluting our existing token holders, so we'd rather not do that, and then want that option price higher up. And in some ways, like the call option almost balances that. Like, in order, depending where you put that strike on the put option, and it might influence where you put that call option, right? And because the true risk starts to balance off, and also the investor may demand more upside if they're going to be being exposed more to the downside. So there's a lot of I'm probably not giving a great answer, but there's a lot of different factors and a lot of different things you can think about, and a lot of it's just down to preference, and just kind of putting numbers on the paper and just trying to figure out what the DAO is comfortable with. And I think it's hard right now because there hasn't been that much being created, or there hasn't been anything created except our token. And I think over time, people will start figuring out what makes sense and what they're comfortable with. But as the market shifts, then that's different as well, right? Like, it's because I think right now, people can imagine like a lot of these DeFi protocols, going up 10x or 20x. Maybe in 2 or 3 years' time, that may not be the case. So then these strikes will start to change, and effectively implying the volatility of these that's implied in these options will start to change over time. So yeah, there's a lot of different factors, but we're also happy to sit down with people and try and work it out and think of ideas of how to structure it.
Thanks, Kevin.
Question, if I could ask a question about pricing. I'm not really sure how risks to a call option or some kind of option paying out is priced in long dated options in traditional finance. But for decentralized finance, you have these things sitting in a smart contract that's sitting on a network, and the smart contract you might want to roll, and the network you might want to move. So is there like a sense in these pricing models that you could substitute in, like, here's the smart contract or infrastructure risk or like cost for longer dated options?
Yeah, I don't know. That's a good question. I almost pass it back to you, John. You might have a better idea than me.
Well, I was just wondering if there's like some equivalent of like, oh, like there's like a legal risk that some written down on paper option wouldn't execute, or like some rules would change or something. So I was curious if there was like an existing variable that you could say like, okay, this variable is maybe like more significant now, but an equation already exists for it, if that makes any sense.
Yeah, I think I kind of get what you're saying. I'm wondering if that's something we could put in one of our price identifiers or UMIP somewhere. Yeah, I don't know. I actually don't know how that would work or I don't have, yeah, basically I don't really have much of a solution at the moment for that. But I guess in the traditional world, I guess these legal documents hold up, but then regulation can change. But I don't know how much people actually price that into their structures, and probably they should, or someone's thinking about it somewhere, like the lawyers are thinking about it somewhere. I guess in the DeFi world, there are no lawyers, so I think that there needs to be maybe potentially some kind of other mechanism if these contracts start to go really far into the future.
Yeah, totally. And I'll just keep thinking about that because I think it's solvable at a technical level. There's got to be a way to roll these options because I don't think if you had like a 10-year option, it's going to get rolled at some point. I can't imagine that it would just sit and run by itself for 10 years and that you wouldn't want to roll it in some way.
Sure.
I mean, isn't it really easy to roll? Like, couldn't you just trade like expiries essentially?
Well, not expiries. I'm thinking more in terms of like you want to make a change to, let's say the token itself has changed, or you need to like support some kind of like an airdrop that would be sort of, I don't know. Like, I'm not thinking of it in terms of like the expiry rolling or like the contract itself changing, like where you put the assets. The asset itself could also change if you have like an upgrade to the token contract, or the asset, like the option could exist on a different network if you want to go to like a different network. Like a bunch of scenarios where just at a technical level, you can't just say like, oh, it's written down on paper and the paper is the same. It's sitting on top of this constantly changing infrastructure. So that's a lot of big open questions there.
Yeah, like if a protocol got bought out by someone and they merged or something like that.
Yeah.
And yeah, then how would you to that token? Yeah, like a lot of interesting scenarios.
Sorry, expiries was the wrong word. I just meant like, I don't know, you could always trade 1-to-1 with like the new contract hosted wherever, or new contract on like a contract upgrade or a host.
I see what you're saying. You would say like in that scenario, you would just create a separate range token and then offer a way for people to exchange that token for the new token.
Yeah, exactly.
I'm just wondering about that because like the agreement, if you're anticipating that something like that might happen, just a lot of interesting questions. And it's less of an issue if it's like a shorter dated option, but you might want to bake into whatever this is, maybe some kind of lightweight legal agreement just related to that. If such and such changes, you might want to move to a different contract, in which case we'll have a facility for swapping 1-to-1.
I want to ask if there's maybe one or two more questions. We do have the sushi kind of community call just after this, so probably want a couple minutes to switch over, but there's time for one or two more questions if anyone has one.
What do you think about a DAO using, like, say, for example, the range token? They mint a bunch and then use them kind of like the KPI options were being used for like incentives for the community and stuff. And then maybe whatever they had left over buying back their debt.
Yeah, I think everything's possible. I think with the I feel like maybe that's more suited for like what part of the operation might be more suited with KPI options if you're trying to incentivize a certain activity. You know, almost think of it as just two separate things, I guess. Like the range token and buying back, that does seem kind of interesting. And then I guess you would probably use the KPI option separately, incentivize certain behavior or activity on the protocol. But I think you're given everything how everything is built. It's quite flexible. You could use it for anything you want, and it maybe depends how you structure it.
And technically, like with the success tokens, right? Like, there's no reason why you like couldn't embed a KPI option. It's like a traditional covered call option, right?
I think that's exactly. I think some people might have discussed it. But yeah, it's definitely a good idea. Wait, are there any more questions?
That's all I got. I really appreciate all the information.
Appreciate everyone's time.
Thanks, Kevin.
Thank you. We'll see everybody on the sushi call.
Thanks, Kevin.